Welcome to the Quote Trader Educational Series. Today, Bollinger Band, featuring Eric Lippert, Technical Representative 3 at eSignal. Hi, I'm Brent Threadgill, Quote Trader's Product Manager. Stick around after this educational series for information on how you can start making a difference in your trading using Quote Trader free. In the studio with us today is Eric Lippert. Eric, thanks for joining us.
Glad to be here.
Well, we're going to be talking about Bollinger Bands. We have some on the screen. Can you give us a brief description?
Yeah, basically, Bollinger Bands are developed by John Bollinger, I think it was about 20 years ago, and basically the concept is that Bollinger Bands measure volatility.
Volatility, what's that?
Basically, when you have wide-ranging bars or a trend, if you'll notice that unlike moving average bands, which are equidistant around a center line, you'll notice on our chart here, the center line is the yellow line, and it's got the two white lines that are dynamically adjust according to volatility. The narrower the bands around the center line, the less the volatility, and the wider the bands around the center line, the more volatility there is.
Fascinating. Now, would this tell us, for example, on this point here where there's low volatility and the bar goes outside, or this area where there's high volatility and the bar goes outside, what does that indicate?
Those lines actually also constitute support and resistance, so a lot of people will trade off. They'll also trade off the center line. If you'll notice at this point here, it hits the center line and just drops right back down again.
And all this is free?
And it's free on Quote Trader.
Wow. So if somebody wanted to add Bollinger Bands or modify their Bollinger Bands, they would just put their mouse, right-click, go to Studies, and select Bollinger Bands, right?
Correct. And that'll bring up your dialog box. And most people will just stick with the default choices, which is the 20-day moving averages. And the last numbers that you see in the box, those are the deviations. Bollinger Bands uses two standard deviations from the center line. You can adjust those according to the market, but most of the time the best thing to do is just leave it at those values. I mean, this has the advantage of, see, when they're narrow, you got less volatility, and then then they expand. And usually, what happens when you have like a really narrow, relatively narrow range, then all of a sudden you get actually a wide range. So you have the cycle of low volatility, high volatility, low volatility.
So somebody could, in this area here of low volatility, could expect volatility to increase.
Exactly.
Wow.
And a lot of people, if they trade options, for example, they'll buy options during low volatility, and then in the periods of high volatility, they'll go ahead and sell them because they're expecting less volatility. A lot of people use a trading strategy actually built around that.
Wow. So using Quote Trader for free could help you make better trading decisions.
Exactly. And it's got a lot of great tools, including the Bollinger Bands.
That was fascinating, Eric. Thanks for your time.
Thank you. I enjoyed being here.
Well, I hope you learned a few new ways Quote Trader can help your trading. If you did, let us know. You can contact us directly by emailing trading@quote.com or visit us on the web at quote.com, where you can get Quote Trader or just more information, including access to online help and one of the most active trading online communities, Raging Bull. Remember, Quote Trader is free, so install it today and find out how it can make a difference in your trading.
Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we learned about the stochastic oscillator, an indicator which helps us gauge momentum in the market. In today's lesson we're going to learn about Bollinger Bands, an indicator which helps us gauge the volatility in the market as well as how high or low prices are relative to their historical price action. So let's get started.
Okay, so Bollinger Bands are comprised of three bands which are referred to as the upper band, the lower band, and the center band. The center band is a simple moving average which is normally set at 20 periods, and the upper and lower band represent chart points that are two standard deviations away from the moving average. Bollinger Bands are designed to give traders a feel for what the volatility is in the market and how high or low prices are relative to the recent past. The basic premise of Bollinger Bands is that prices should normally fall within two standard deviations, represented by the upper and lower band, of the mean, which is the center moving average line. If you're unfamiliar with what the standard deviation is, you can read about it in the link which I've included in the description section if you're watching this video on YouTube or one of the other video sites, or just below the video if you're watching it on informtrades.com. As this is the case, trend reversals often occur near the upper or lower bands. As the center line is a moving average which represents the trend in the market, this line will also frequently act as support and resistance. The first way that traders use the indicators to identify potential overbought and oversold places in the market by watching for touches of the upper and lower bands, or trading outside of those bands, which tend to represent extremes. Although some traders in the market use a close outside the upper or lower band as buy and sell signals, John Bollinger, who developed the indicator, recommends that this method should only be traded with the confirmation of other indicators. Outside of the fact that, as we've talked about in previous lessons, most traders would recommend confirming signals with more than one method, with Bollinger Bands specifically, prices that tend to hug or even trade outside of the upper or lower band for long periods of time, specifically in strong uptrends or downtrends, and that's obviously not a situation where you want to be positioning for a reversal. So because of this, selling the upper band and at the lower band is a technique that, if you are going to use, and actually a pretty good technique if used with other indicators, in range bound markets. Okay, so that's what we're going to look at here. You can see here it's a chart of the Qs, which is the NASDAQ ETF. And you can see here we have a ranging market there, we have a trending market here, and you can see that in the ranging market we had multiple touches of both the upper and lower band, but in the trending market it was hugging the upper band for a good portion of that time. Now, the trade setup here, we could look at, just buying or selling on a touch of the upper and lower band, but a better method would be to combine with another indicator, which I've done with RSI here, which you learned about 2 lessons ago, and you can see that you've got a divergence here as price moves up to a new high, but RSI does not confirm. So there would be your sell point, and then the buy point would be when the close would be when the market pulls back off of the lower band, because in range bound markets we're anticipating that a move that starts at one end of the one extreme, the high band, is going to move all the way through to the low extreme, which is going to be the low band. And so we don't want to get out of the trade before it's finished following through. If it goes into a downtrend, it continues to hug that bottom line. We want to be in that trade, so we're going to wait for a pullback off of the bottom Bollinger Band line. Okay. The second method is what's known as the Bollinger Band contraction, and in general, after periods of low volatility in the market, the market tends to rally rather significantly, because as we've learned in some of our other lessons, periods where the market doesn't move that much up or down are indication that neither the bulls nor the bears are winning. So when one side does win, the market tends to move pretty dramatically in the direction of the winning side, whether that be up or down. So low volatility is obviously represented by contracting Bollinger Bands, and high volatility would be represented by widening Bollinger Bands. So you can see here we have a contraction in the Bollinger Band there. And then we have a break above the top Bollinger Band, meaning that the buyers have won out in this situation, and we have a nice run up after that. Now, be careful when you're trading this strategy, because if you do trade this strategy, because a lot of traders say that the first break above or below the Bollinger Band line tends to be a fake out, so it actually reverses and goes in the opposite direction, and a lot of traders will trade the second break to avoid getting faked out and pulled into a trade in the wrong direction. Bollinger Bands, because they're an indicator which is plotted on price, are just a good indicator to use with other things, such as some of the things that we've learned so far here. So by looking at this chart, and if you've been through some of our other lessons, you should be able to identify the double top there. You should also be able to identify the divergence in that top, which is represented by the relative strength index, meaning that not only do we have a double top, but going up into that second double top, there was a loss of momentum compared to the first top. So you can also see the touch of the Bollinger Band there, and that represented a pretty good move down in the market after that. Okay. Now, there's lots of resources out there because Bollinger Bands is one of the most popular indicators. So I've included a link to some of those below this video if you're watching it on informedtrades.com, or in the description section if you're watching it on YouTube or one of the other video sites. As always, now that we're talking about strategies and everything, remember that trading is risky. Nobody, certainly not me, can guarantee you profits. You should design your own strategies. This is just meant for information purposes. Make sure you do your homework before getting into the market, and make sure that you're only trading with risk capital and that trading fits into your investment profile. Okay? So that's our lesson for today. In our next lesson, we're going to learn about something called the ADX, or the Average Directional Index, which is going to help give us an indication of the strength of the trends in the market, strength or weakness of trends in the market. So we hope to see you in that lesson. As always, if you have any questions or comments, please feel free to leave them in the comments section below, and have a great day.